So this is like a tax explainer. It's going to explain essentially what's in the tax return. It breaks down the tax return into 6 steps essentially. So let's go through them, starting from the income all the way down to the taxes owed or tax refund. Okay, so this is an example client, Peter and Paula, and they've essentially come to me. Their CPA has prepared the tax return. It's not been filed yet, so it's in a draft format. They've sent it to me, and I've given them access to my tax software, and they've essentially uploaded the PDF of the tax return that the CPA prepared for them. And now I'm going to review the return together. So this is like a tax explainer. It's going to explain essentially what's in the tax return. It breaks down the tax return into 6 steps essentially. So let's go through them, starting from the income all the way down to the taxes owed or tax refund. So for Peter and Paula, the tax return, when you click on income, it shows that they have about $198,000 in ordinary income and about $36,500 in capital gains. So the total income is about $234,650. So when I'm reviewing this with them, I'm literally walking them through, what makes up all that income. So I'm asking them, hey, on your 1040 line A from your W2, did you earn $124,000? In this case, yes, I think it was Peter that earned that income. Paula has a business of ours. So we just confirmed this line. We cross-check on line A from their from W2. Secondly, they have taxable interest, which is on line 2 of their form 1099B from a broker like Fidelity, Charles Schwab. So they have about $6,000 in interest that is taxable. Similarly, they have $3,000 in ordinary dividends. Again, they'll look at their form, they have 1040 from their broker, right? It's going to be in line 3A. So we're cross-checking those line items. Is that number correct? And they confirmed yes, it's $3,000. So we're making good progress here. In Peter and Paula's case, they took out some money from their IRA. And because they are not yet over the age of 59 and a half, the distribution is taxable. So in this case, they've gotten a form 1099R from their broker custodian, and it's on line 4B. And what the total amount that is taxable is $9,750. If they were over the age of 59 and a half, it would not be a taxable distribution. It would have just been reported as a distribution, but not taxable. But in this case, they are under the age of 59 and a half. No exception applies, so it's all taxable. And I think this income belongs to Paula. Yes, it is. So Paula owns a business. It's on a Schedule C, business income, credits, and offsets. The net income. So this number will be the net income. That is, what was the gross income? After taking out expenses, what's your net profit? That's what's flowing through to a 1040. So in this case, she has about $52,900, almost $53,000 in income that needs to be reported. And then they also have from Schedule D. I'm going to ask them to cross-check. They had some short-term capital gains. They sold some securities under 1 year or less. So it's taxed as short-term capital gains. So they can confirm with me that yes, it's short-term. We can always check that again. It's going to be on their Schedule D or 1099B. Okay. And then they also have some capital gains and qualified dividends. So this will be taxed more favorably, than ordinary dividends. Ordinary dividends are taxed as ordinary income, whereas qualified dividends are taxed at capital gains tax rates, which are between the, it can be 0, it can be 15%, or it can be 20%. That's the maximum under the current tax law. Ordinary dividends are taxed at ordinary income tax rate, so it can be as high as 37% if possible. So in any case, qualified dividends on their from their 1040 line 3A is $17,000. Again, this would have come from one of these 1040s, from 1040, from one of their broker or custodian statements. So we'll just check that again. And similarly, this would have also been reported from one of the 1099s. And in this case, they have about $19,500. So again, I'll just check with them. Hey, did you sell any securities that you've held for more than a year? And we'll just check the amounts on their 1040 forms, 1099 forms, pardon me, on their 1099 forms from their broker or their custodian. So essentially, what we've gone through is that we've gone through the first step here. The first step is to check every income item that has been reported on their tax return against whatever documents they've actually received from their brokers, their employers, essentially, right? So that's what we've done. We've checked everything. So now let's move down to the step 2, which is now let's start checking for any deductions. So remember, they started with about $234,000 in total income. That's what we just went through. So now, to get to the adjusted gross income, we're going to take out some deductions. Those deductions that you take out before gross AGI, your adjusted gross income, those are called above the line deductions, right? Above the line deductions, in their case, is just about 37. So what are those above the line deductions for them? Well, in Paula's case, she has a deduction for a self-employment tax. Given that she has her own business, right? The US government gives you a deduction for half of your self-employment taxes. And in this case, she has about $3,737 that she can take as a deduction against her income. There are other above the line deductions. For example, if you contribute money to an IRA, that will be an above the line deduction. There are other things that maybe if you are an educator or a teacher and there's some educational expenses that you bear, those will be above the line deductions as well. So anyway, let's keep moving on. So in their case, they only have $3,737 in above the line deductions. So that brings their AGI to $230,913. So I'll just check that with them. Do you have any other above the line deductions? And I'll go through a checklist. HSA contributions, things like that will be above the line deductions. I'll just go through a checklist with them to check if they have any other above the line deductions. In this case, they do not have any. So their AGI is just about $231,000. So now from the AGI we now move to taxable income. Before you get to taxable income, you can now take out deductions that are below the line, right? We've gone through the above the line deductions. Essentially, above the line deductions, what they mean is that they are not limited by income, right? That's what it means. They're above the line. It means that you can have as much income and those deductions will not be limited at all. So HSA deductions, deductions for half of your self-employment taxes, right? Those kind of deductions are not limited by your income. Below the line deductions, unfortunately, are limited by how much you make, right? That's why it's below the line. So it's going to be based off your AGI, right? So whatever your AGI is will limit the amount of deductions that you can claim for those for those deductions that are below the line. So let's look at some of them that they have, right? So in their case, they have state and, well, we call them SALT, but state, local, and other taxes deducted. They most likely have more than $10,000, but currently it's capped at $10,000 under the current tax law. Okay. The mortgage and interest expense deduction is $22,000, right? And then they have gifts to charity, which is $10,000 as well. And then they have QBI, qualified business income deduction. This is from Paula's business. It's about $9,832. So we'll just cross-check each line item, to check. I'll check with them, hey, what was your total SALT, taxes, what's your mortgage interest expenses. Usually this is reported on one of the 1099s from a broker, from a mortgage company. We'll check that. Usually online, box 1, right? And then this gives to charity. There's usually no reporting that comes officially from charity, so you will need to, have your own records typically. Sometimes you might get some receipts from charity. Keep them. We'll use that to cross-check. And then the QBI deduction just comes in, as you file your Schedule C, or whatever your business income expenses are, that will naturally just flow to your 1040. So in that case, they have about $51,000, or almost $52,000, $51,832 as deductions. And if you're taking a closer look, you see that they are actually taking itemized deductions versus itemized standard deduction. The standard deduction for a couple, I think this is 2023 returns exactly, would have probably been somewhere around $29,000. So the itemized deductions is higher than their standard deduction. So it makes sense for them to take, what is almost double what their standard deduction would have been. Okay, they do not have any expenses here or deductions here, pardon me, that are limited by their income. To be honest, an example of a below the line deduction that would have been limited by their income is like medical expenses. Those are typically limited to anything above, say, 7.5% of your AGI, your adjusted gross income. Anything in excess, right? Any medical expenses in excess of your of 7.5% of your adjusted gross income is usually what you are able to deduct, right? And there's some other examples. Let's just pause here and let me just recap. So they had a total income about $234,650. They had some above the line deductions, specifically Paula's business self-employment taxes. She can deduct half of it. So she took out about $3,737. So that brought their income from $234,650 to $230,913. And now below the line deductions, they have about $51,000, almost $52,000 of below the line deductions. So that takes their adjusted gross income from, that brings their income from $230,000 to about $179,000. That is now their taxable income. Okay, so you go from your income, you take out above the line deductions to get to your AGI, adjusted gross income, and then you take out below the line deductions to get your taxable income, right? Now, based on your taxable income, right, then you get your total tax, and our total taxes will be based off a tax bracket, right? So, if you look at their total tax, in this case, they are going to be paying about $22,000 in ordinary income taxes. They'll be paying about $5,475 in capital gains taxes. Capital gains taxes is essentially, let's go back to the income here, is based off this capital gains and qualified dividends. Remember I mentioned earlier that capital gains and qualified dividends are taxed at more favorable tax rates than ordinary income. In this case, they'll be taxed at a maximum of 20%. It can be as low as 0, or it can be lower at 15%, depending on what the tax bracket is. And then the ordinary income taxes is taxed at the higher tax rate. So if you go back to their total tax, so they are paying about $21,983 on $198.50 and $150, pardon me, of income, right? That's what they're doing. That's what's happening here. So their total ordinary income of let's call it $22,000. They're paying that on ordinary income of about $198,000. On $36,500 of capital gains and qualified dividends, they are paying $5,475, right? So that's what the total the capital gains tax is. Then they have additional taxes. This might be for something. This is most likely for other taxes, like maybe they have their income is too high, and maybe they have something for they might have been taxed for their taxable IRA deductions. Remember, they they are under the age of 59 and a half. So given that they might have taken, they did take money out of the IRA, they will pay taxes on those IRA distributions, and there's possibly a 10% penalty on that as well. Okay, so that's the other taxes. Oh yes, by the way, so on the capital gains taxes, you see it's for them. It says that this is taxed at 15%, right? Whereas their ordinary income taxes was actually taxed at 22%. Okay, the highest is taxed at 22%. So anyway, the point I was trying to make about that is that their capital gains tax rate is just 15 versus their ordinary income tax rate, which is as high as 22%. And then lastly, they will have additional taxes for taking money out of the IRA, as well as penalties in addition to that. Okay, well, let me take a step back. So actually, let me correct that. So their other taxes is right here is for their self-employment tax. This is the portion of self-employment tax for Paula's business. So 7,475 is the total amount. And then remember, she got half of that as a deduction, right? So half of 7,475 is what she got as a credit earlier, not a credit, a deduction, $3,737, I believe, right? So that is the total taxes. That's the breakdown of our total taxes. So let's keep moving on. So now they owe about $35,000. Now, how much have they paid towards that? So let's look at how much credits and payments their CPA has captured that they've paid. So it shows that they have non-refundable credits up to $9,700. $2,500 of that is from child tax credits and credit for other dependents. They have $1,200 as dependent care credits, and then they have residential clean energy credit of $6,000. So this will be amounts that I'll clarify and confirm with them, and encourage them to check if the amounts have been fully captured or underreported or overreported. So in any case, they have $9,700 of non-refundable credits. They do not have any refundable credits, unfortunately. So I'll just confirm that with them as well. Do you have any refundable credits, or do you qualify for any? In this case, their CPA has captured that they have none. And lastly, their payments. This would be through, Peter's W-2 withholdings and Paula's estimated payments if she's made any throughout the year. So let's check. Well, in this case, actually, it's just through estimated withholdings for Peter. So he has, in this case, we'll check his W-2. So on his W-2, I think line, can't remember what line, maybe box 2 or 3. Somewhere there, they would have reported the amount of taxes that his employer has already withheld towards taxes. So all in all, they have $25,000 in tax withholding, as well as $9,700 in refundable credits, for a total of $34,700 in credits and payments. So this is almost matching what they owe in taxes. So the net amount that they owe is just $232, right? And this is the full breakdown, top to bottom, what we just went through. So line 1, they had $235,000 approximately in income. Line 2, their AGI was about $231,000 after taking out $3,700 and change for Paula's self-employment tax deduction. Then line 3 is the taxable income of about $179,000 after taking out about $52,000 of below the line deductions. And then line 4 is the total taxes based off the total income. And remember, there's 2 or 3, breakouts of these taxes. About $20,000 of this, I believe, is their ordinary income taxes. I think about $5,500 is for their capital gains and qualified dividends, and the rest, about $7,500 or so, is specifically for self-employment taxes for Paula's Schedule C for our business. And then we now confirmed just now that they have about $35,000 already, or $34,700 already withheld as taxes through Peter's work, as well as $9,700 in tax credits. And in a nutshell, they owe about $232. So we've just gone through that. I think this has taken, I don't know how long the video is taking, about 20 minutes. This is what I would have done with my clients as well. And essentially, this process gives clients a lot of peace of mind. I found that a lot of my clients, when they've gone through this process, they love that it's straightforward. They've reviewed it. They've done their own part. And then their CPA or whoever is preparing their tax returns, even if it's them self-prepared, it gives them some level of confidence that they've done their best, right? And they've taken that step, one extra step towards being good stewards of their finances. They feel very comfortable that they've taken an extra step. So I hope this has been helpful. I know it's been a detailed video, but I hope you found it helpful. If you like this video, please comment, share, and please subscribe to my channel. I look forward to seeing you in the next video. God bless you. Take care. Cheers.